U.S. still in recession, and consumer demand isn't coming back, not anytime soon. Perhaps not for a decade or more. Not anything like the levels of 2006 or 2007, before the global economic crisis hit full force. You've heard the current version of history over and over. Consumers got ahead of themselves in the past few years and spent money that they didn't have by running up balances on their credit cards and treating their houses as ATMs. But this time it's different. The consensus opinion on Wall Street, in Washington, D.C., and on Main Street is that it will take some time, maybe as long as 2 years, to work off the excesses of the past couple of years. And then, supposedly, consumer demand will return to something like the level of the years before the global economic crisis. Consumers may not go back to spending like it's 2007, but they will spend like it's 2006 or 2005 or... But is anyone terribly convinced by that story? It's just that the alternative is too grim to contemplate. Most folks in the financial advice industry and most politicians in Washington would rather go whistling past the graveyard and hope nothing bites them. But there's a good chance this story and this reading of history are wrong. Not a certainty, but a very good chance. There might be an alternative history of the global consumer that makes waiting for demand to come back to normal absolutely wrong. It's at least as likely, more so. Demand gone but not forgotten. The result of investing in anticipation of demand coming back to pre-crisis levels would be absolutely painful if it's wrong. Stop worrying about whether the current downturn will become a full-scale correction of 10% or worse. We've been through that. We know sort of how to deal with it. But if global consumer demand isn't set to bounce back, then investors face a huge challenge. The behavior of global consumers in general, and of U.S. consumers in particular, over the past 20 years was an aberration, and that what we're seeing now isn't the beginning of a gradual recovery to the spending levels of the years before the global economic crisis, but a return to the long-term spending and saving trend that stretches back to 1945, or something like that. If that's the case, the global economy is indeed awash in excess manufacturing and service capacity, because companies and industries had projected future consumer demand by drawing trend lines from consumer behavior over the past couple of decades. They then built factories and service networks to meet that projected demand. But the global economy isn't going back to that trend line. Over the next decade or more, industry after industry isn't going to gracefully absorb that temporary extra capacity. Instead, the global economy could be in for a decade or more of tooth and claw fights for market share. Bloody consolidation as industries are forced to radically shrink capacity, and an increasing number of the walking dead that are kept alive only by large infusions of capital from national governments. A recent piece from global consulting company McKinsey fleshes out some of the details of this alternative history from the McKinsey Quarterly. Like many other consultants these days, McKinsey has been busy asking consumers about their spending plans. In March 2009, for example, 90% of the U.S. households McKinsey surveyed said they had reduced their spending because of the recession. Approximately 33% of respondents said they had reduced spending significantly. Roughly 45% of those who had reduced spending did so because of necessity. More than half of those who said they had reduced spending said they plan to keep their spending down after the recession ends. But again, this time is different. These are times like never seen before and will never be seen again. Consumers are not only spending less, they're also borrowing less and saving more. In the quarter ending in June 2008, net consumer mortgage borrowing turned negative for the first time since 1946. In March 2009, the personal savings rate reached 5.7% of disposable income, a 14-year high. That still lags the post-1945 average of 9%. There's nothing startlingly new in these findings. Everybody who does a survey these days is finding that consumers are spending less. With unemployment at 10% officially, 17% or more if you count the discouraged who stopped looking and the people working part-time who want full-time jobs. Any other result would be surprising. But what is unusual in McKinsey's survey is the consulting group's willingness to think that the trend of the data depends on how long a slice of time you look at. If you look at just the past 20 years or so, then the move to a 7% savings rate and a negative number on net mortgage borrowing seems like the outlier that will be hammered into insignificance by the trend. If you take a longer view, however, and look at the years stretching to 1945, then it's the zero savings rate of 2008 and the mortgage debt blowout of 2006 to 7 that look like outliers. We don't think we can say anything certain about that trend, but the odds increasingly point to a conclusion very different from a scenario in which consumers will relatively quickly start spending like it's 2006 again. Even though we can't say anything about the long-term trend with complete confidence, we don't think that means we can't say anything at all. First, we do know from the evidence of the Great Depression and other economic events that what changes consumer behavior is duration. The Great Recession hasn't yet lasted nearly that long. But periods aren't defined quite so neatly. The stock market bubble that broke in October 2007 was the second bubble of the decade. And there could be more bubbles building. The combination of the two, the tech bubble that broke in 2000 and the mortgage bubble that broke in 2007, marks out what many of us have begun to call the lost decade for U.S. investors, in which the stock market indexes went nowhere and net returns were close to nothing. The pain drags on. This was also a period when a relatively shallow recession was followed by very slow job growth, when real incomes stagnated, and when workers learned that just about anyone, union or non-union, big company or small, profitable enterprise or money-losing business, could lose a job to a buyout, to offshoring, to global competition. By itself, the Great Recession is the longest economic downturn in the United States since the Great Depression. And it's really not over yet. For one thing, continuing high unemployment makes the recession feel like it's still going on. Real living standards are falling if you factor in price hikes or cuts in public services. And again, this time is different. These are times like never seen before and will never be seen again. These are the end times, transition days. A real transition is happening. It's an ongoing process happening all around the world, day by day.